our first panel, that's going to be looking at the widening gap. It will take a deeper dive into the risks and explore why this dichotomy has opened up between digital innovation, which has brought financial services to many, many more people, and yet we see financial health around the world declining. The FinAccess data for Kenya showed this very well. It showed that in 2016, we had financial health measured at almost 40%. By 2021, it had fallen in half to 17%. And that's in a country that's been the poster child for mobile payments. So what's going wrong? What's happening here? CGAP came up with some equally troubling data in a report that came out in February. It said that globally mobile app transactions 2019 to 2020, that is during the pandemic, of course, rose by 38%, but the level of fraudulent transactions went up at twice that rate, to 83%, which explains why so many of you are identifying that as an issue. And who is most exposed? Low-income women and rural customers. So clearly, there are a lot of risks here, a lot of issues that need to be confronted, along with the rapid innovation that has opened up. Your moderator for this session, looking at why this widening gap, is Kate McKee. She's a longtime advocate for empowerment through financial and economic inclusion. Many of you also know her for her leadership in CGAP's agenda on the responsible finance, consumer protection, and the handling of data, where she was also very active in the RFF in identifying emerging risks. So I'm delighted to hand over to Kate for the first panel.
Thank you so much, Stella, Mayada, and Sharmila. I am personally very thrilled to see that the Responsible Finance Forum is being relaunched and that we all have this opportunity today to explore together where and how it can have the most impact. Responsible finance, that phrase seemed deceptively simple yet powerful when our German friends back in 2009, it was GIZ and KfW, proposed it as the topic of a field-wide convening. Then we were in the throes of the global financial crisis, which reminded us that access to finance could be a two-edged sword, especially for consumers whose life circumstances, roles in the economy, and limited income and assets made them more vulnerable to the turmoil in the financial markets and its spillovers into the real economy. Over the years, it was exciting to come together in this forum roughly every year, and the themes evolved as new issues arose, as new evidence came in, and as innovation accelerated. I think about the last forum that I had the privilege to participate in planning and convening, which was in Berlin, and the topic was data privacy and protection. And we had really very deeply, sometimes even emotional and philosophical and very practical discussions about these issues. At the time, to some, it seemed like, well, that's a developed country issue, not a developing country issue. And now I see that it was actually prescient and that some of the risks we were concerned about have presented, and some of the solutions we were proposing were actually relevant, and they needed a rather long lead time. So I really am very motivated by the new vision for a revitalized Responsible Finance Forum, and I think this work is very important. The context now is really different from 2009, but the uncertainty feels eerily familiar. And we really, I think in some ways it feels even more challenging, and this work feels even more urgent. We've seen tremendous progress since then, and yet the persistence of some of the old risks is also troubling, as is the tendency for new risks to rise quickly and fall disproportionately on more vulnerable consumers. And we will see shortly, as we look at measures, different ways to think about financial health, well-being, stress, how this can erode trust of those consumers, it can erode their financial health, and the benefits they get from changing their own financial behavior. The old tools we talked about in those days, provider business incentives, industry standards, consumer awareness and nudges, policy, regulation and supervision, still seem essential, but sometimes not sufficient. So we're hopeful that new developments in digitization, distribution models, use of data, and other tech-enabled innovations might also help address the new responsible finance agenda. In this session, we'll discuss the emerging evidence on the disconnect between financial access and financial health, as well as exploring ways that evidence on emerging risk can be used to motivate action and drive behavior change amongst key stakeholder groups. We have three brilliant and accomplished panelists with decades of experience relevant to this agenda to help guide us down this path. Leora Clapper is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. Her current research studies the impact of digital financial services, especially for women. She's a founder of the Global Findex database, the latest findings of which came out yesterday. It was a great launch, and I would strongly recommend that anyone who missed it watch the YouTube recording, which had an exceptionally dynamic panel discussion. I particularly like that part. And there, Leora, I've plugged it, so now you don't have to, although you can. Amrit Khair is a senior research advisor for Financial Sector Deepening Kenya, FSD Kenya, where she's responsible for driving a research agenda that effectively supports FSD's partnerships with industry and policymakers. And last, but certainly not least, is Pia Tayag, the director of the Office of the United Nations Secretary General Special Advocate for Inclusive Finance for Development, known as UNSGSA. Pia leads the team that supports Her Majesty Queen Maxima of the Netherlands' work as the UNSGSA. She has deep experience as well as a regulator and policymaker from her work with the Philippines Central Bank and the Alliance for Financial Inclusion. Each of the speakers will make an initial set of comments in response to a question, and then we'll come back for a follow-up question. And then we've tried to reserve 15 minutes at the end for Q&A with the audience. So be sure to use the chat function in order to pose your questions to the panelists. And they'll be gathered, and we'll be able to probably tackle a few of them. But as mentioned earlier by Stella, the LinkedIn group will also be an ongoing means to address these issues. Feel free also to use the chat to highlight any additional risks that you think need to be on the agenda, and any evidence you want to bring to the table. Leora. Excuse me, fill out your question. The Global Findex has historically measured access to and usage of financial services. The 2022 survey results, launched yesterday, shed new light on consumer financial health, including financial stress and resilience. Can you tell us more about these metrics and the findings, and whether, as the title of this panel suggests, we are or are not observing a widening gap between financial access and financial health?
Thank you for that question. It's really a pleasure to be here this morning, right after yesterday's launch, especially since when we first started collecting the Findex data, we really focused in 2011 on ownership. Just, do you have access to an account? In 2014 and 17, we expanded questions around payments, use of accounts. And then in 2021, and this was really designed before the pandemic, we expanded the module on financial well-being, both on resilience, but also on financial stress and worrying. In addition, as I'll get to a little bit later, we also have some really important new questions on the ability to use accounts responsibly. So just to give you, I can't start without get to the highlights, the headlines. We found account ownership varies widely around the world. We surveyed 123 countries in 2021, ranges from 6% of adults in South Sudan to being almost universal in high-income countries such as Canada and Germany, UK, as well as Mongolia, Thailand, other upper middle income countries. And the good news is that we're seeing account ownership continue to grow. The gender gap has narrowed for the first time. And we really, this is exciting because of this generation now of research that bring evidence that access to accounts, to payments can really benefit people. Women in particular can contribute to lowering of poverty, increasing consumption of food and other necessities, increasing spending on education, health, and businesses. Other development goals also include improvements in well-being, which is related to a person's financial resilience, which we loosely think of as the ability to deal with unexpected financial events, and the level of stress generated by common financial issues, and the level of confidence in using these financial products oneself without the help potentially of an agent or a driver or a family member. So to measure financial resilience, and we sincerely thank so many collaborators. These questions were improved based on discussions with the IPA Financial Health Measuring Group, UNSGSA's Financial Health Measuring Group as well. So to measure financial resilience, we asked the following 3 questions. So imagine you had an emergency. Could you come up, what would be the source? Could you come up with emergency money in the next 30 days and in the next 7 days? The amount of money is about 5% of GDP per capita. That comes out to about $3,200 US dollars or $320 in India. And so we've piloted our questionnaire around the world. We sit in people's homes and we ask them the questions open-ended. And we sort of pry a little bit to understand their answers. What seemed like mysteries to us in Washington, the financial decisions often make a lot of sense to people, especially women living in developing countries. And so we've asked this question now for 10 years, and this is a question also asked by the CFPB, the FDIC in the US, and others. And a woman would tell us, women would typically tell us in developing countries, I would depend on my family. Yes, I could come up with the money. I would depend on my family. And I follow up and say, well, who would you get the money from? How likely is it they'll send you the money? And she would reply, this is literally the same story over and over again. Oh, I'd ask my sister, but her husband would never let her send me the money. And it's happened enough, and even from men, who just weren't sure they really would get the money. This also came up with a question around work. How would you raise this emergency, this extra money? I'd work more. And then we'd say, well, how likely is it you could find extra work? And especially among the self-employed, well, I probably couldn't. I would try, but I'm not sure I could. And so we added this additional question. How difficult would it be to actually come up with the money? And so the choices ranging from not difficult at all, somewhat difficult, to very difficult, or simply impossible. And we think this is an important nuance. And so, for example, in 30 days, in high-income countries, almost all adults say they could come up with the money, although there's still about 20% who say it would be very difficult or impossible. Whereas in developing economies, it falls from 87% who say, yes, I can come up with money, to only a little over half who say they're reliably. The 7-day nuance is important because some emergencies, you can't wait 30 days. And so this is more of a, you have access to this money now. An interesting nuance which we're looking into is, there is evidence from Sub-Saharan Africa, for example, that people with better access to payments, such as mobile money accounts, can get money quicker from a wider geographic and social network of friends. Important caveat is that this was certainly asked right after a systemic pandemic, right? So media was that before the pandemic, you had more confidence depending on your family, but during the pandemic, everyone was suffering. I would say that this is still important. It's not only pandemics. Think about extreme weather events, which are increasing in frequency and intensity, or any other event that would affect your entire community, really highlights the need for dependable money. And so looking more closely at the sources. And so here we split out by source. People would say they're, for example, about half of adults, about 30% of adults say they would rely on family and friends for extra money in an emergency. But nearly half of those say the money would be really hard to get. In MENA, over half report depending on family and friends, and over half say it's unreliable. In sub-Saharan Africa, more than 60% of adults rely on family and friends for emergency funds in 8 economies, including Kenya, Mali, Senegal, South Africa. And so, and not surprisingly, we also find that women are more likely to depend on family and friends and more likely to say that the money would not be reliable. And it's just, and I guess to bring out some, regional differences again, about in China, Mongolia, which have very high savings rates and relatively higher formal labor force participation rates. Around 40% of adults say they would use labor earnings in an emergency, and most say it would be reliable. As in comparison, in India, Brazil, Bangladesh, over 30% of adults say they would depend on extra extra work in an emergency, but only about half of these adults say it would be somewhat or not difficult to raise the money. And as I mentioned, women in the poor are more likely than men and richer adults to successfully raise extra funds and more likely to depend on family and friends as their go-to source. Importantly, and just to sum really up what we're finding, is that adults in developing economies who save formally and use saving as their first line source of funds in emergency are most likely to get the money when they need it. And of course, this is dependent on income, dependent on other factors and cultural factors. However, there's a body of literature, including DeFlo and Banerjee, et cetera, that even the very poor can put away a little money for emergencies, for future goals. You see the encouragement of having this money and the importance of formal financial services to help support people to build resilience. And let me just end my response with some really interesting new data we collected on financial stress, which is a really important part of your financial well-being, your literal financial health. There's a really interesting literature showing that financial stress not only causes physical stress, but also affects your productivity, your ability to focus on your livelihood. And so, again, not surprisingly, we did draft these questions pre-COVID, during the COVID era. Half of adults in developing economies are very worried about one of these stresses. In high-income countries, only about 20% of adults are very worried about any of these stresses. About 50% of adults in developing countries are very worried about covering health expenses in the event of a major illness or accident. And over 35% say healthcare costs are their biggest worry. There is some interesting exceptions. In South Asia, in LAC, about a quarter of adults are most worried about their monthly bills, including about 50% of adults in Brazil and Colombia. In East Asia Pacific, about 30% of adults are very worried about old age. What I find really interesting in this figure is, and very important, how in sub-Saharan Africa, worry about school fees dominates as the most common worry overall, for over half of adults, and the biggest worry for about 30% of adults. And women are 5 percentage points more likely than men to worry about school fees. And it really points to, how can we help design better financial products to help adults, plan for and save and plan for these expenses, smooth their spending, and relax their financial stress. So I'll stop there. Thank you, Kate.
Thanks so much, Leora. That's really fascinating insights from consumer research. And we're going to come back to you later on and ask you to explore a little bit more the points you were raising at the end about the concept of financial health and the implications of financial stress and worries. Let's turn now to Amrik. You are going to present some of the FSDK research insights that span the demand and the supply sides of the market. More specifically, Kenya has always been flagged as a leader in financial services for the poor in general, but as a leader more recently in fintech and digital finance. And yet the FinAccess survey, the findings of which you're going to present, has shown declining levels of financial health over the past 3 years including pre-COVID. Can you tell us what the data is showing and what are possible explanations of these trends in the fast-moving Kenyan market?
Sure, thank you, Kate. Let me just see if I can quickly share my screen. Okay, I think someone is doing, put up my slides for me. Thank you very much. Yes, I mean, it's really fascinating, by the way, just to hear Laura talk about the Findex findings and, you know, to see many parallels with the findings that we're seeing in FinAccess, and also some sort of interesting deepening. You know, I really appreciated the question, her last question actually, which shows something that we know very much from the Kenyan market, how important areas like education are in terms of people's sort of investment goals. And it's good to bring that out, showing how important it is for people not just to be dealing with shocks and emergencies, but actually really to stimulate investment in their futures. So over to the Kenya data. I mean, as we know, you know, we have had this sort of strong growth in uptake of formal accounts, which has been mainly driven by digital technology, and you can see that in the green parts of the bars on the chart on the left, on my left. And that's true across, you know, savings. It's true across in credit markets. We've seen strong growth in credit markets in the last 5 years. And then similarly, even in the daily use of accounts, you know, which has also doubled between 2016 and 2021. But at the same time, the other chart on the right shows that this is a question we ask about people's financial needs. We first of all ask whether they have had any of the following needs, whether they've had to bridge a liquidity gap or address a shock or are attempting to meet a goal. And then we ask what financial strategies they employ to do that. And we ask about their main financial strategy. And here we see that formal finance really has a minimal role for people in helping them to meet these core financial needs. And in fact, that's even declined actually recently, probably driven a bit by the pandemic, whereas the grey bars, which show these non-financial strategies that Laura already described, like working more, but also selling assets, cutting back on expenses and so forth, are dominating people's sort of options for trying to address these needs. Could we go to the next slide, please? And so what does this mean, you know, in terms of this mismatch, in a sense, between financial uptake and ability to address financial needs? What does it mean for financial health and for the ability of formal finance really to drive financial health? And I think here we also need to sort of step back even further and look at the context of finance, you know, the context in which people's financial lives and financial decisions take place. And we've heard quite a lot about that already on this webinar, on this workshop, whatever it's called, sorry, webinar. And we see again in FinAccess that people have faced declining levels of economic opportunity since 2016. There are more people finding jobs in from lower paid avenues like casual labor, and even more an increased level of dependence on others for livelihoods. Whereas there's been a reduced number of people able to find work through business and employment in the same period. And correspondingly, we also see that income has stagnated between 2016 and 2021, whilst cost of living, particularly food prices, have risen by 85% during that time, which puts tremendous pressure on household budgets. And then more recently, since 2019, we see incidence of shocks has actually doubled across the population, particularly cost of living shocks. I mean, this is you know, large financial shocks. Cost of living and health sort of dominate there, which shows that you know, the population is increasingly sort of exposed, if you like, to risk. So it's unsurprising that financial health has fallen across all demographics, albeit you know, in differing degrees and at different times. For example, the wealthier groups were particularly affected during the pandemic years, whereas we saw steep declines in financial health among the poorest and middle poor between 2016 and 2019. So I guess this forces us to ask the question of, to what extent can developments in the financial sector influence financial health in a context where social, economic and political pressures leave in low-income economies, leave so little room for maneuver. And I'd like to argue that, you know, to produce dividends for financial health, we need to anchor Kenya's development agenda much more strongly in relation to inclusive growth, rather than growth per se. And the implications for finance are that this entails much greater integration across the macro, meso, and micro layers of the financial sector. For example, how can we need to ask ourselves the question of how do we ensure that efforts at the macro layer to mobilize green bonds or develop effective distribution networks for social security complement efforts at the meso layer to stimulate production and trade through finance and value chains and supply chains, and as well as enabling more value-adding solutions at the micro layer for households and small firms. Stronger alignment across these different layers and positioning financial sector policy more squarely in relation to inclusivity as well as growth, I think would go a long way to reversing the trends that we're seeing in financial health. And I think I'll stop there. Thank you, Kate.
Thank you so much. Really important evidence. And I know you're going to show us a little later what's happening specifically in the digital credit market, which adds more texture to this picture you've painted. Pia, let's turn to you. The results we've heard today from the latest Global Findex and FinAccess surveys add more evidence to something we've observed for many years. Financial inclusion, and perhaps particularly access to credit, comes with risks, particularly to low-income consumers with less margin for error. Reflecting back on the work you did as a central banker and now in supporting Queen Maxima, the UN Special Advocate, how do you read this evidence, and how has it changed your perspective on the potential priorities for financial inclusion?
Thanks very much, Kate. First of all, thank you for having me here. I'm happy to be here in the reimagined RFF and following these two excellent presentations with very deep insights. I think, Kate, it has not changed my perspective in terms of priorities, but actually have sharpened what we have been saying all along about financial inclusion. And Queen Maxima as UNSGSA is also very consistent in the message that financial inclusion, we have always seen it as not the end in itself, but as a tool or as a means to an end. And what is that end? Really, for access to financial services, to be able to help or to be tools to build resilience and seize economic opportunities. And those financial products need to respond to the needs and capacities of the customers. And so, it's very compelling to see AMREC's data on the inability of that access to actually respond to the needs. And also, we've always known that customers are at the center. There is a role to play for everyone, for regulators, for financial service providers. But in financial inclusion, we always wanted to see whether we are including those that are unserved meaningfully into the financial system that benefits them. And I think a final perception or belief that we had on financial inclusion is that it is also does not exist in a silo. It is closely linked to other policy objectives, consumer protection, stability, and the other public policy objectives that we have, inclusive growth, as AMREC has mentioned as well. So I think these beliefs have not changed, in fact, strengthened, especially by the evidence we are seeing, especially with what we experienced in the pandemic, and really with more data and questions that we are asking ourselves as an industry and also the broader stakeholders. And I think in relation to this, I'm happy to hear all the insights on financial health and well-being. In 2020, Her Majesty convened a working group for financial health, really to see whether financial inclusion contributes to financial well-being. And maybe I could just share a slide on, or is someone sharing the slide on just the definition of what we mean by financial health. Maybe I could just go through it. It's really, financial health is the extent to which a person or family can smoothly manage their current financial obligations. So this talks about day-to-day, and also build resilience and the capacity to absorb financial shocks, have goals and the ability to meet them, and have confidence in their financial future. I think these are components that Amric mentioned that are included in the Financial Health Index. Also, Leora, about the aspect on worrying and feeling secure about the finances. This definition was really meant for us to have a common objective. It is a state rather than contributing factors or behaviors, to make it very clear what we want to aspire for and what we want to measure. And financial health, there is a role to play for each stakeholder. For example, for regulators, what nudges are you putting in place in terms of policies? I think before we had the ICIP framework that CGAP was working on looking at inclusion, stability, integrity, protection. So in looking at this as well, as we push for financial inclusion, are the policies also really contributing to financial health? Government policy, for example, on government-to-person payments. We want to roll out digital payments for social safety nets, but are they designed to help their beneficiaries build savings, for example, or access other services such as insurance? So these design choices also need to be at front and center when we look at these policies. For financial service providers, there is also a role to play as we design products, as we use the data that we have from our customers to be more bespoke in the services that we offer. Are we really understanding the needs and whether these could benefit the segments that we are trying to service? So there is really a role to play. And when we look at financial health, it is not a progression. It is not something we think about after we have the financial inclusion or everyone has access to finance. But it is actually a lens in a way we think, how do we want this financial inclusion to happen, whether we are policymakers or providers, and really leading to this outcomes focus. And I think the Findex, the research from FSD Kenya, the pandemic, all of this is really making us rethink, what are the opportunities and risks, but also really cementing us to our original proposition of financial inclusion, really as a tool for development outcomes, for positive development outcomes, for the individuals we're trying to support, the communities, and really for broad-based and inclusive growth. So thanks very much, Kate, for that question, and all the panelists for such wonderful insights.
Thank you so much, Pia, and we'll come back to you in a few minutes. I'd like to turn back to Amric now, though, and ask, as you reflect on the story of digital credit and credit-like products in Kenya, what are your observations on the risks that have emerged so far and those on the near horizon? And we're wondering really, what can this leading case study of rapid innovation and growth tell us about the challenges and opportunities for responsible finance, as well as drivers that would make such services more relevant and responsive to the needs of lower income Kenyans?
Thank you, Kate. And clearly digital lending has really sort of been very much at the forefront of that discussion on responsible finance and even on financial health, actually. And it's sort of in Kenya over the last 10 years, we've seen our lending landscape change very dramatically, really driven by digital offers. This began with the emergence of bank-based lenders who were under the purview of the regulator, quickly followed by the first digital app-based lenders who were not subject to regulation. But it was really sort of 3 years or 4 years after that we saw this explosion of digital app lenders on the market, all of whom were outside the purview of regulation, and who really pushed the envelope of what we would consider to be acceptable practice, including debt shaming and the emergence of sort of fraudulent apps. And also more recently, concerns over the use of credit bureaus as an exclusionary tool through reporting low-value loans, which prevent users from future access to credit, without very expensive forms of redress. So in this light, among other things, we did see sort of some action from within the industry with the emergence of the Digital Lenders Association, which is an industry body, which attempted to kind of sift a bit the good from the bad. As well as sort of a lot of public outcry in the media, which kind of, I think, reduced sort of practices such as debt shaming. And in fact, Google even went as far as banning fraudulent apps from sort of being on its Play Store. So all of that, I think, sort of helped a little bit to rein in that market. But then more recently, what we've seen is this sort of new product in the market, which has sort of taken the market by storm. And this is the mobile money overdraft. In fact, Fuliza product delivered by Safaricom in partnership with NCBA, which is a bank, which allows users to access instant credit to complete M-Pesa transactions. So it sort of acts a little bit like airtime credit used to, acts. The success of the Fuliza, which has increased 63% since 2020, rests partly, of course, on Safaricom's near monopoly over the payments infrastructure, but also on its deployment of transactional data, of which it has a sort of a bird's eye view in a sense. And at the same time, though, recent FinAccess data does show us that we've seen nearly 50% of mobile money users claiming to have experienced incidences of fraud or loss of money, and that incidences of people claiming to have defaulted on loans has sort of trebled in the last couple of years, between 2019 and 2021. So that was the sort of situation really, by the time we last did our FinAccess survey last year. And at the same time, we also saw rather worryingly that there was a sort of a retraction of mainstream digital lenders, mobile bank-based lenders like KCB and Mshwari from the market. There are, the value of lending of Mshwari and KCB reduced by 42% and 52% respectively from the start of the pandemic. And the use of digital app loans went down from 8% to 2%. So we've seen this sort of retraction of many of the lenders from the market, and this kind of taking over of the market by this new mobile money overdraft, which, some people claim provided a lifeline for Kenyans, particularly during the COVID period. And I think in this context, it's important to note that Safaricom's leading edge in the market stems partly from its unparalleled access to transactional information and its use of that information. And given the risks of lending into these volatile and risk-prone markets, it's essential that lenders across the board are able to leverage that kind of very granular information in order to manage risks and deliver strong and tailored solutions that can help markets such as small businesses and women, for example. And in fact, we see the rapid retraction of lending at the start of the pandemic, suggesting that lenders were not using a data-driven approach and were just sort of reacting to the uncertainties born out of the pandemic and its effects on the wider economy. So what are the implications for governments and for regulators? I think on the one hand, we see the increasing need to protect consumers through responsible regulation. But on the other hand, the concentration of the market around these mobile money overdrafts suggests there's a need to stimulate a broader-based market for lending, which can cater to a range of credit needs in the market. So since 2019, the government has in fact instigated a number of measures to control lending markets and protect consumers, including placing a limit on negative reporting of loans of less than $10, and suspending unregulated digital credit providers and from participation in credit information system mechanism. But in 2021, it also published new regulations aimed at bringing these unregulated digital credit providers into the regulatory ambit of the central bank. And those regulations are now beginning to come into effect. So, these recent efforts by government are sort of laudable, but it will take, of course, some time to understand their impacts for consumer outcomes and where the gaps in regulation still lie in order to really strengthen the health of credit markets in Kenya. Furthermore, I would want to say here that the development of effective credit markets does require more than just consumer protection actions. It also requires aligning incentives and supporting much stronger information systems through interoperable data universes, effective credit information sharing systems, and data for development, which government is best placed to mandate. And I think Safaricom example really shows how well they've used data to deliver a range of products. And so we need to make that data really available to many more players in order to stimulate a range of tailored solutions for different needs. So at root, really what the Kenya story points to is not just the need for digital innovation to solve our sort of inclusive finance needs, but the critical nature of infrastructure, policy, and public debate to align to these wider development goals, which are both responsible for protecting consumers while being responsive to stimulating finance for growth. Thanks, Kate. I'll end there.
Thank you so much. I really like the distinction you made right at the end between responsible and responsive, and not that it's an either or, but that both are really critical. And I think even relevance might be another R word that we would apply in our screen on contributing to financial health. Pia, more than a decade of focused work on responsible finance has shown us that bringing about meaningful change in the incentives and behavior of market actors is far from easy. Thinking about the evidence that we need to marshal and the focus that RFF Reimagined has on that, what are the opportunities you see going forward for more effective ways of spotting emerging risks, assessing and improving consumer outcomes? And do you see that continued digitalization and application of new technology, while it could bring some new risks, might also enable better understanding and a focus on consumer financial health and outcomes? And just before you answer, I want to remind everyone to be using the chat function for any questions that you'd like us to ask in the speed round at the end. Thank you.
Thanks, Kate. And meaningful change is often very hard and does take long. So I think one big opportunity is that we are making progress, and that there are a lot of learnings that we are having as a community, as stakeholders. And I think that's the biggest one. The second is, of course, the technology. I mean, today when we started, Stella took a poll and in a few seconds found out the demographics of the room. And even more, surprising is that in another second, she asked how people felt around the room. And so just getting that sentiment and getting some information about the people in a few seconds really gave us enough tools to really see how do we frame the discussions and to sort of put a perspective on what we are hearing around the room. So I think there are tools, there's technology available, and what I want to highlight as the opportunity here, of course, as regulators, we always think about the risks, right? But also looking at the opportunities, is that these tools are available for everyone. And it's important to know, what do we want to use it for? And are we asking the right questions? So for example, for regulators, I mean, if we wanted, if we call it in the past, if we wanted to understand how financial services were being delivered and consumed and how they were affecting the consumers, it would be very difficult for regulators or supervisors to know that, because our data or supply side data from our supervised entities, there is a lag. We have very manual, even customer interface or complaints. But right now we could get that kind of information. We could have really have a true customer-based consumer protection framework, for example. And I know CGAP is working on this, or to really understand the risks to the consumer. So there is technology available. Are we asking the right questions? We are able to measure, are we analyzing it correctly? Are we putting the lens of the policy objectives that we want to achieve? And here, looking at inclusion, at financial health, for example. These tools are available for the private sector and for providers. And we have seen that in how, use of data has designed products, has really become, has been more agile in development and delivery. Again, asking ourselves, are we measuring, are we learning from our consumers whether these products are actually supporting their needs, and are they helping lead to their well-being? There's now an ability to measure that as well in the way we design products and services. And I think finally, those tools are available for consumers themselves, which I think was not the case also. It has not been the case in the past. And there's now more channels to be heard, more channels to communicate with our service providers and with the regulators as well. And so I think that is where the opportunity is that we also democratized access to this technology for the stakeholders to be able to make that meaningful change. And I think that's a clear opportunity, and maybe just to flag how we can make that work, for the consumer is really capacity is one across all those stakeholders, understanding the questions, what is available, and analyzing this data that we are having, and also dialogue, across stakeholders, as I said, regulators, financial service providers, and consumers. And I think, the consumers have a role. It is a shared responsibility, but of course, public policy needs to step in place. Government needs to step up to also address digital literacy, financial literacy, for example. So these are opportunities, and just highlighting some building blocks that we need to make sure that the tools and the opportunities are used for good and really lead to the positive outcomes that we want.
Thanks so much, Pia. And I really like the notes and examples of why we might be optimistic also about our ability to stay more on top of things and have more real-time interaction and have that observable by policymakers, regulators, and other stakeholders. Very, very good points. Leora, coming back to you, your presentation has stimulated lots of reactions in the chat stream. I want to ask you a kind of a broader question. Looking forward, what do you think? What's your advice about what needs to be done to improve measurement and understanding of the outcomes experienced by financial services consumers? And what kinds of evidence on consumer risks and behavior do you think the RFF stakeholders should really prioritize getting their hands on to inform and incentivize more responsible and responsive financial markets?
Thank you. And I guess the comment, I fully agree with some of the comments in the chat that access to financial services could improve financial well-being, can help people build resilience, help people save, to invest in business, educational opportunities, but only if the consumers understand the financial products and are being protected against fraud and other illicit payments. I think it's also important to recognize that the onus for good financial behavior shouldn't rest completely on the consumer. There's growing evidence from mystery shoppers. Some colleagues are working on in collaboration also with Innovation for Poverty Action, showing that countries around the world who try to open an account, who try to take out a loan, are often not either provided incomplete, missing, or misleading information that offer the best product or the best cost. And so, ensuring that there's a strong and enforced consumer protection framework around agents, around the offering of products is also important. And so, to answer your question more directly, so in Findex this year, so we expanded, I mentioned the resilience, questions about financial stress. We also try to put in some additional questions on people's ability to use financial accounts themselves. And very importantly, when we talk about the digitalization of payments from the government, from employers, for some workers, right? Certainly there should be choice. And also, it's important that workers understand how to withdraw the money so it's not harmful to them. We did work long ago in an African country showing that people receiving government payments, they didn't understand there was a balance inquiry fee. And so the ATM, they kept checking their accounts and the money kept declining. They were losing up to 10% of their government welfare payments to bank fees. In Bangladesh, the Center for Global Development did a nice study showing that mothers receiving payments, again, about 15% of these mothers said they were worse off because they didn't have the confidence or the capability to go to the agents themselves to get the money, and were sending their husbands to get the money for them, and therefore losing the control over the money that the program intended. So we added new questions. We've started off, with the feeling that financially inexperienced users may not be able to reap the benefits of financial inclusion. They don't understand how to use the products, the risks of the products. And so we asked the question of the unbanked adults. And again, we also have to recognize that as financial inclusion has excitingly grown, index finds 71% of adults in developing countries now have an account, the bottom of the pyramid is getting less literate, less financially numerate, and we need to be more careful when we're expanding account ownership among this demographic. So we have to be unbanked. And again, this is a hypothetical question, which I'm a little more skeptical about, but yes, if you were to open an account, could you use it yourself without help? And this is important because we know when people have to ask for help from an agent, or in Pakistan, we hear that women often use the driver. They hire a TikTok to drive them to the agent or to an ATM and ask the driver to withdraw the money for them, or a family member. They're being more exposed to fraud, illicit fees, loss of the control over the money. And we find that about 70% of unbanked women, that's 58% of unbanked men, said that if they open the account, they could not use it without help. And again, this is important for us to recognize when we're designing these products, especially among the unbanked. In terms of using products, we asked the question only in sub-Saharan Africa of adults who said they had a mobile money account. So 33% of adults on the continent, sub-Saharan Africa, have a mobile money account, use a mobile money account. It's much higher in many countries. And about a third of mobile money account holders, users, 33% of women, 28% of men, say they can't use it without the help of a family member or an agent. And this is the kind of information, I'm sure the telecoms and the fintechs are collecting, and that policymakers need to be aware of as well. And again, how to ensure that the governance of agents, that there's an appropriate consumer protection framework to protect adults who are using agents, and also thinking about solutions. For example, the use of biometric identification is one way in some countries that's allowing less financially sophisticated customers to use accounts themselves. I'll also mention, there's also a behavioral angle on the importance of learning by doing. So for example, in our study, I did a study in Bangladesh where we looked at garment workers who were receiving their wages in cash and switched them to electronic payments directly into an account. And one of the most important findings is that workers who are paid into an account, relative to workers who only have an account, who don't have that use case, the workers paid into an account are more likely to report making financial transactions themselves, sending remittances home, for example, from their mobile money account to their family without the help of an agent, using an ATM machine outside the factory on their own, giving them this financial empowerment. We also find it very nicely we did a small study where we sent agents into mobile money agents around, we sent actors into mobile money agents around the factories in Bangladesh. At factories that had electronic wages, the agents near those factories were less likely to ask for informal illicit fees from people coming in to do financial transactions. And again, controlling for various biases, it's suggestive that giving people, with the proper introduction of an electronic payment, with ongoing support, we can build more financially savvy customers. And finally, on that note, and with thanks to Eric DeFlo, who helped me draft this question a few years ago, we actually asked one use case. So we asked a question only of adults who report receiving a wage payment, a private wage payment into an account. And we asked, were there any unexpected fees along with this transaction, on your transaction? Again, I don't know if people just simply didn't know about bank fees, such as balance inquiry, withdrawal fees, or maintenance fees, or if the agent was shaking them down. I don't know. We didn't have the space. This is a ripe area for more qualitative and quantitative work. We just asked, were there any unexpected fees in the transaction? On average, about 1 in 5 adults who receive a private sector wage payment said there were. Who receive a wage payment into a financial institution account. Again, this excludes mobile money accounts. Okay, so a banking or similar institution account paid unexpected fees in the transaction, and it was higher in some countries. South Africa, 27% of adults receive a private sector wage into an account, and 6% of adults, almost 20% of the private sector wage earners say they paid an unexpected fee. In Uganda, in Uganda and Kenya, there, where it's more mobile money accounts, we find in Uganda over 40% of adults received wage payments, reported unexpected fees. as in almost a quarter of wage payment recipients in Kenya. We also saw some relatively higher number in some of the Eastern Europe, Central Asian countries. And so overall, points to, again, what we really believe are the tremendous opportunities of electronic payments to give workers, government recipients greater security, safety, privacy, and control over their money. At the same time, we need to ensure that workers receive ongoing support, how to use their accounts responsibly, and a strong and enforced consumer protection framework. So thank you.
Let's see, Maya. Thanks so much. That really fantastic. We've had an amazing set of comments and questions in the chat function, and we really can't do justice to them. So I'm going to very arbitrarily put out one question to each of the panelists that they get 1 minute to respond to. So this is our speed round, but rest assured, your questions are going to feed into the LinkedIn discussions and the future agenda of the RFF. So Pia, I'm thinking, starting with you with an easy one that we never debate at all, which is, what role does financial education and literacy play, as opposed to some of the other tools you've mentioned that consumers have or should have? So you'll get a minute on that. I'm going to put the questions out now. And then Amrik, a question for you. Digitization is exploding in informal savings groups in Zambia. How can we improve interaction among the informal, formal service providers on digitization and consumer protection? A minute on that simple topic. And then Leora, I want to come back to you and ask you for your single most important piece of advice to the RFF about pursuing this agenda. Pia, take it off. Take it away. Don't take it off. Take it away.
You're saying it's an easy question, but it's actually—
Oh, that was very ironic, calling it easy. Yes, it's something we hardly ever debate.
Exactly, but it's a very difficult issue, and we've talked about this many times long ago, Kate. And financial literacy, and also, if I may add, digital literacy, is just such an important prerequisite to seizing all these opportunities we talked about at the panel. But who does it, right? And how? And what is the most effective way? And I think there's so much learnings out there on responsibilities, both by the public sector, but more importantly, by the private sector and providers, on how to even design products already intuitively and have the necessary nudges that can help support, good financial behavior. So a short answer is that everyone has a role to play to address the financial literacy gap, the digital divide. And, we really need to build on the learnings, what works best, heuristics, point of sale, all of that. We need to take that very seriously as an industry. And if I may, Kate, there's just one question that came out in the chat about incentives for providers on financial health.
Please.
I just want to address that because I think it's intrinsic to action. And on the provider side, I mean, the business case for looking and caring about the financial health of your customers, we have some examples about customers being more likely to buy other products, to be loyal customers. So there is a business case. But beyond that, there is a case for each stakeholder. For regulators, it supports other policy objectives. And of course, for customers, it contributes. I think underlining that is very important. I mean, digital financial services provides all these opportunities. We need prerequisites, public goods, we need enabling regulations. But at the end of the day, we have to be very focused on the outcomes that we want, and that access to financial services really leads to well-being and tools to seize economic opportunities. And there's a role to play for everyone, for sure. So thank you. Thanks for that. Not so easy, but opportunity to answer.
Thank you. And Amrik, the question has come up throughout about high assisted finance. Leora talked about that quite a bit. Combining high touch, low touch, where the human interaction comes in, the importance of maybe social networks. So we have a very concrete question from Zambia then. And what advice would you have for Betty and her colleagues on keeping an eye on some of the
I think
risks
it's a great question, because sorry, Kate, my internet blipped. I interrupted you. Yes. Okay. Yeah. Yeah, no, just to say it's a great question. And, you know, I think one of the things we've been trying to argue for in Kenya is much stronger integration between formal and informal financial provision, you know, with all actors really sort of aligning around that, because there tends to be this kind of, oh, that's the informal sector and now we're concerned with the formal sector, but they're coming together organically. I mean, we see a lot of young people now using these digital tools like WhatsApp, in fact, to create these little financial groups. And so, you know, Betty and her colleagues are quite right that, you know, there's a lot of this going on now. And of course, as a researcher, my first response will be, well, we need more research, because I think, you know, we don't understand. We could sort of say, well, look, we need to have more education and sort of, you know, building of capabilities among informal users so that they can effectively use these formal products without being exposed to some of these risks. We can say that, but do we know that that's the problem? We do not know. It's a very unknown area. And certainly in Kenya, we're seeing a lot of youth actually engaging in these digital financial groups. And so, and there's, you know, many of them are quite savvy. In fact, some of them are the ones that are sort of almost gaming the system. I mean, there's one step ahead of the system in a way, you know, so we don't actually know what the needs are there yet. And in fact, we're just doing a little deep dive as we speak in Kenya on these newly emerging digital groups and you know, and their financial practices. And I think I'm hoping, I'll be talking to the researchers tomorrow again, actually, I'm hoping that I can actually pose this question to them. Please make sure you include questions on consumer protection, because we need to know. So that would be my first answer. I mean, there may be some opportunities around social media. Twitter has been used a lot to call providers to account, for example, for adverse practices or to expose, you know, irregularities or experiences of consumers. You know, so maybe there's mileage there as well. But I think we need research to answer that question properly, and we need to invest in that. Yeah.
Thank you so much, Leora. Take us across the finish line with your advice.
I fully support the call for more research, and also identify things like gender gaps as well, and income gaps. You know, that after, for example, after the government digitalizes the program, make sure that we follow up with the women who are these, you know, often, you know, payments to mothers. Make sure that these mothers understand how to use their account, understand the fees, and understand how to use this account to improve their lives. Perhaps the most exciting for me finding in this year's Findex was the use of mobile money accounts in Africa for savings, right? So these accounts were designed to make P2P payments effectively. And we're now finding a quarter of adults in Kenya, Ghana, and elsewhere saying, I am saving for the future. And this is a perception question, saving in my mobile money account. 15% of adults in sub-Saharan Africa on average report using their mobile money accounts for savings, right? And so how can we meet them? And perhaps they're not earning interest on these accounts. Perhaps they're not able to use it to build appropriate credit histories for a business and so forth. And so understanding how people are using, and again, looking at the mobile money accounts, what's so interesting about it is that we actually went to Ghana to ask women, all these women who had bank accounts, who told us they're only saving using susus, which are guys on a moped who pick up money and give it back to less than $1 a day. So these women are paying to keep the money outside their home. What they tell us is that, it doesn't make sense. I'm not going to take a bus across town to wait online to put $1 in the bank every day. That's not what banks are designed for. But now they're able to, often costlessly and, conveniently put $1 a day with an agent on their block, keep the money safely outside their home to meet their monthly bills. And so, I think America is referring to keeping up with users, understand users' financial needs to improve their lives, how they're making financial transactions, and for providers to meet them and support those needs and use cases. Thank you.
Thank you. Well, it's hard to believe that an hour has flown by here. My final takeaway is that, yes, there are old risks that haven't been solved. There are new risks that are emerging, but that technology and the way that finance is delivered can also be used to help find the solutions more quickly and for it to be clearer and faster to all the stakeholders what needs to be done. And it is no longer radical to propose a broader stakeholder accountability for consumer outcomes. We can do it, and we have the tools for it. Thank you so much to the panelists. Fabulous comments.